Today I'm going to talk about the market in general. You guys can see my screen, right?
Yes.
Yes.
Okay, so before I start, so basically, you guys know about the recent market downturn from 2022 because of the inflation worries, right? So
Yes.
from 2022, the market started to fall, and then now it's starting to recover. So I'm trying to explain in today's episode. Uh, in general, what's going on in the market, what caused the fall in the market, and what potentially we could expect in the future. Okay, so first of all, I will just talk about the Fed funds effective rate. Okay, so this is the Fed database. This is the St. Louis Fed website. Um, okay, so for most people who are like in tune with the market or probably know about this website because you get all the information you want about the economy, economic indicators. All these will be in the website. So we look at the Fed fund rate first. So let me just narrow this down. So maybe down to 2020. Okay, so prior to the January 2022, the interest rate has been close to near zero. And you know why the interest rate is close to zero? Do you guys know why?
Is it because they want to stimulate the economy? Because I remember the COVID incidents has make a lot of businesses suffering. So I think one reason
Yeah,
keep it down to help them out.
it's exactly because of the COVID. So if I extend it a little bit longer, I mean back in the future, but in the past, you can see that prior to COVID, the Fed actually raised the interest rate. Okay, so maybe before we talk about this, first I talk about what exactly is this Fed funds rate. So the Fed funds rate is the overnight interest rate, interbank overnight interest rate, where they uh, lend to each other. So for a bank, they need to keep a required reserve in the banks, right? So for overnight, they need to keep some cash with the Fed. So the cash is needed, just in case there are withdrawals from the bank. It's also after the financial crisis in 2008, you need to have some kind of liquidity and buffer in the Federal Reserve. So the overnight interest rate. Okay, when we say overnight interest rate, we mean 1 day interest rate. So you keep the reserve in the bank, in the Fed, and if you don't have enough cash, you will need to borrow from the interbank market. So you have to borrow from other banks, and the rate that you can borrow is the Fed funds rate. So what the Fed will do is that they will target an interest rate, and the bank would eventually, so they will target a range. So right now, the range is 5.25 to 5.5%. So this is the target range that the Fed wants the overnight interest rate to be at. And I will explain later how the Fed is able to make sure that the rate is within the range. Uh, I will explain that later. So prior to COVID, the Fed actually raised the interest rate. I forgot exactly why at the time the interest rate was raised, but as soon as COVID struck, then you can see that they cut interest rate right down very fast to close to zero. And then starting from 2022, because of the inflation was getting really high. At the time, the market and the Fed was thinking that the inflation was only transitory. So that meant that the inflation rate, the high inflation, is probably will go away soon. But turns out that the inflation didn't go away soon, because at the time due to COVID side issue, people were thinking that once the supply side issue goes away, then inflation will come down. But it turns out that inflation was sticky, and it wasn't exactly transitory. So the Fed started to raise interest rate. So this is the part where it started to raise very fast. So it's like started, I think, with 25 basis, then it went up, then 50 basis, and 75 basis, and then it tapered down. And now the interest rate is pretty much constant, in the sense that the Fed is no longer hiking or cutting interest rate. But now the next move for the Fed will be potentially to cut interest rate. But now inflation is still high. But before I continue, do you guys have any question?
Yeah, I have a question. Is usually interest rate will be generally tied back to the other interest rate, like for example, property mortgage, interest rate, etc. I don't recall at that time during 2020 was mortgage rate less than 1% loan. It wasn't that low, right?
I don't
That's like
remember.
less than 1%.
Yeah, the interest rate was still low. At that time, I believe that the Fed wanted to slowly raise interest rate, probably because of inflation as well. So normally, what the Fed does, what they want to do when they raise interest rate is purely to fight inflation. So I believe at that time inflation was starting to creep in, but as soon as COVID struck, inflation actually fell very fast, and 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 the problem is no longer inflation problem, right? It was because of the economy is going down into a recession. If you look at this gray shaded area, this actually means that there is a recession. And yeah, but this is a very short, I think this is like the shortest recession on record. So even though there was a recession, it went over very, very quickly, because first the Fed cut interest rate massively, right? As you can see, it cut interest rate very fast. And second of all, it's also because of the money printing, the QE, quantitative easing, and also the Fed was also has this. I mean, this is not the Fed, but the government, the fiscal policy, they have a stimulus package, and they started sending a lot of money to the household in the US, and that caused the inflation that we have right now. Part of the reason is because of the extra stimulus that check that the government was sending out to the US household. But anyway, for us right now, we just need to be aware that overnight interest rate was low during the COVID, and then starting from 2022, because of inflation, interest rate we started to have this hike in the interest rate. Okay, so we go on to the next tab, which is okay. So okay, this might be a little bit technical, but I'll just go over quickly. So how does the Fed control the interest rate such that it is within the target range? So the target range is 5.25 to 5.5, and we can see the effective rate is 5.33. So when we say it's an effective rate, it's actually the weighted average of the actual transaction that is going on in the interbank market, which is close to 5.33, which is the rate that the banks are actually lending to each other. So in order to achieve this, so the Fed can achieve this, is that they can give, okay. So in the past, the Fed does open market operation. So open market operation means that, if the Fed want to lower interest rate, it will start to buy treasury bills from the bank. So when they buy treasury bills, those bonds, the Fed will inject cash into the to the economy, and so this would lower down the interest rate, because if you buy bonds, so you will cause the bond price to go up, right? And if you do know this, the interest rate and the yield on bonds and the bond prices, they have an inverted relationship. So if the bond price goes up, interest rate will go down. So by the act of buying bonds, it will cause the interest rate to go down, and subsequently, if the Fed want to raise interest rate, it will sell treasury bonds to the banks, and then this will cause interest rate to go up. But that is what happened. This is what used to happen in the past, before the '08 financial crisis. But post '08 financial crisis, the Fed no longer does, in terms of targeting the interest rate, they don't really do open market operation. I mean, as far as I know, they move on to other ways to do it. So one way to do it is from the interest rate on reserve balances. So when bank keep cash at the Federal Reserve account, in the past, the Fed would not pay interest rate, but now the Fed will pay interest rate on those extra reserves, and the interest rate would act like a ceiling. Wait, is it the? Wait, let me see. Yeah, it will act as a ceiling on the interest rate. So, by offering this interest on the reserve that you keep in the Fed, it will cause the interest rate to not go over the. Okay, so for example, this is 5.4%, right? So which means that the Fed will pay 5.4% on reserve that you keep in the Federal Reserve. So this will ensure that the interest rate will not go higher than 5.4%, right? So because the Fed is risk-free, because it will not default it's considered risk-free, right? So at 5.4%, it will so no other banks will pay higher than 5.4%. So this act as a ceiling on the rate. As for the floor, this will be the overnight reverse repo. So you don't have to exactly know what is a reverse repo, but basically a reserve repo is a way for you to lend extra cash that you have. You can lend it to the someone else. In this case, will be the Fed, and the Fed will pay you the overnight. It will pay you interest rate, and this will act as the floor in the interest rate. So in this case, it's like 5.3, right? So we have 5.4 and 5.3. So by using this two mechanism, the Fed is able to control the interest rate to where it wants the interest rate to be. And to give a little bit more details about reverse repo. So a repo is a way for you to borrow money. So what you do is that you will offer a treasury bond as a collateral. So you will pass the collateral to the person that is lending you the money, right? So for example, I'm a bank, I want to lend you money, but because of counterparty risk, so I will take your collateral, which is a treasury bond or bill, and then I will lend you the cash, correct? And then if it's an overnight repo, the next day you'll pay me back the cash. Then I will pass the collateral back to you. So this is like a securitized lending. So in case you default, I will keep the collateral, which will be the bond. So reverse repo just means that is from the perspective of the bank that is lending you the money. So for example, I have extra cash, I want to lend people money, then I will do a reverse repo. Okay, I think this is a little bit too technical, but okay, so basically you can see that this is how the Fed can control the interest rate.
Trying to understand the basics of interest rate, how would this directly affect the general population in terms of obviously interest rate will affect, like if anyone wants to take a loan, whether it's a personal loan or a property loan, obviously it will affect the businesses taking having the interest rate, and this will be passed on to the consumer in terms of their prices at the end of the day as well. Trying to understand how would this also affect investments like S&P, for example. Is there
Okay,
any
so
effects on it?
yeah, okay, so it definitely will have an effect, but the effect is not so clear cut. It's not so straightforward. Wait, let me just narrow this down first before. Okay, so what exactly is interest rate? What do you guys think? You want to like try to define interest rate?
For me, it is how much I'm paying the bank for my mortgage, right? In terms of what I'm having right now.
Right, but the one is more specific to the property market. But like, can you simplify the definition to something that is even simpler? Like,
Okay,
what
so
exactly do you mean by interest rate?
for me, it's just a revenue for the lender to, if I lend you money, of course I want something in return, right? So I lend you X amount of dollar, I want the interest. So it
Yeah.
goes it go, if you go upstream, it goes to from the government, for example, then it trickles down.
Correct. So, I mean, that's a description of interest rate, but okay, basically the definition of interest rate is just the cost of borrowing money, just the cost of money borrowing, or the cost of lending money, right? Interest rate is just simply the cost of borrowing. So if interest rate were to go up, that means that the cost of borrowing goes higher as well, right? And the reason why, you know, interest rate affects the market is because if the cost of borrowing goes up, because the cost of borrowing is very generic. For example, for mortgage payment, it's the cost of you borrowing from the bank to buy your house, correct? But in terms of a company, a corporation, the cost of borrowing will be to borrow money to expand the business or for day-to-day running of the business. So when your cost of borrowing goes up, it means that it will affect the bottom line of the company. That means your net income will go down, right? Because you need to pay more for your interest payment. So in that case, it should be, it's supposed to cause the market to go down, because it will affect your earnings. Yeah, you will affect the earnings of the company. And earnings, ultimately, the stock market is driven by earnings of a corporation that is in the market. But the market price is not really the earnings of the company per se. It's a future expected earnings. So anything that affects the future earnings will be reflected in the market. So that is what we call. So that's one way how interest rate will affect the stock market. And another way is also because of the complicated relationship with inflation. If inflation were to be very high, that means that eventually, even if the Fed doesn't raise interest rate, Well, it will cause the future expectation of the interest rate to go up. And it will be reflected in the bonds of longer duration bonds. I mean, like bonds that are longer in terms of the maturity. That will go up first, right? So that will cause future expectation of the interest rate to go up. So it doesn't even mean that, in order for the interest rate to affect the market, it doesn't mean that okay, how should I put it? It doesn't mean that the Fed would increase or cut the interest rate like now. It doesn't mean that. It means what the market expects the Fed to do in the future. Like, for example, why is the market going up now? Like since October last year, right? Like why the market went up, especially from October. It's because the market anticipate that the Fed is going to cut interest rate this year, right? So I mean the Fed hasn't even cut interest rate yet. So it's the expectation of what the Fed will do in the future that is driving the market. So that's the complicated part. And the market actually priced 6 interest rate cut this year. Initially, at the beginning of the year, they priced in 6 interest rate. So when we talk about 6 interest rate, like how do we know that the market priced in 6 interest rate cut? And why 6, not 5? Like how do you get the number 6? So they have this Fed futures that they interest rate futures that they trade in the market. So these futures are a way for the market to bet on what is going to happen in for example, at the end of the year, what is going to happen, right? So in terms of the futures price, you are able to back calculate how many what is the interest rate that you expect at the end of the year. So they look at the futures price, the Fed futures, interest rate futures, they can see that it will go down. Okay, let me see, show you the calculator. So the number 6 comes because of the 25 basis point. So if you 6 multiplied by 25 basis, which is okay, so 25 basis point means that 0.25%. The reason why they always like to use basis point is because it's a mouthful. They keep on saying 0.25, right? And because normally interest rate move very, very small, so it's very seldom that you will have like a 100 basis point and above. So it will always like mostly be below like 1. So so it's easier to just say 25. So that means that the market see the interest rate will fall 1.5%. And the reason why it's 6 and not just one cut of 1.5% is because they reckon that the Fed will just cut slowly, right? So they will cut slowly. So they will cut 25 basis point. Then the next meeting, they will cut another 25 until the end of the year, it total sums up to 1.5%. But of course, the Fed doesn't have to cut 25 basis point. It can cut like 50 basis, right? That means it will cut 5 times. So one time 50, then the rest could be 25. Or they can cut first time 25, another 50, or you can cut just 150 basis point in just one meeting. But anyway, so that's the beginning of the year. But it shows, but then it seems that inflation it seems to be very sticky. It doesn't come down very as fast as the market anticipated. So now they think that the Fed probably will only cut 2 times this year. And the earliest cut will come in at probably during the September FOMC meeting in September. But the interesting thing is, last Friday, was it Wednesday? The job report is always out on a Friday. So the payroll report came out on Friday, which showed that the job number actually went below expected. It came down lower than expected. So now the market is saying the job market seems to be, starting to come down, right? Because part of the reason why the Fed is very hesitant to cut rates is because the job market is very strong. And they are worried about this wage price spiral, which I'm going to explain later. I mean, if we have time, we will explain it later. If not, we will explain some of in future podcasts. But the Fed is afraid that the wages will keep on going up. But now it seems to be pointing down, that the job numbers is going down and wages is also going down. So now the market is thinking, oh, you know what? Maybe the Fed might cut rates sooner than expected. And there are also signs that inflation is also, it might be coming down faster than we imagine. And that might be a potential for a potential deflation